It's time for the market update.
The dog days of summer are upon us right now, and rates, I guess, have kind of stayed pretty steady, right? But I know inflation has been down and starting to creep down, it seems, month by month.
Yeah, so the month-over-month inflationary measures, CPI, core CPI, are coming down. So that's good. It has not yet translated to mortgage rates coming down. So mortgage rates are still in the upper sixes, in some cases over 7, depending on your credit score and other factors. So what we think is that they are definitely going to come down because the Fed is working really hard to curb inflation. It's one of their two mandates. They have two mandates. One is keep inflation at 2% over the longer term and to maximize employment. And so there's still talk because some of the economic indicators are still running a little bit higher or hotter. So there's still talk of the Fed raising interest rates at their next meeting and possibly even one more time before the end of the year. So interest rates are sensitive to that. Mortgage rates, 30-year fixed rate mortgages in particular. So, or 20 years or 15 years. So because of the pressure that the Fed might still exert, the upward pressure on rates, they have not yet come down. But we feel like in the longer, the mid to long term, 6 months to a year out and further, we think rates are going to continue to or really start to come down as inflation continues to come down and maybe the economy slows down a little bit, supply chains get back to normal. So we're going to trend in that direction, but we hoped we would be there sooner, and we're not there yet. The rates are not coming down as quickly as we had hoped.
You're probably feeling this as well, but it just seems like there's this, you think you said lingering, like this lingering kind of just this haze that's over us, kind of like those wildfires have just kind of sat on different areas of the Northeast. And it just seems like we've been here in recession for a little bit, that this could be on the horizon. And just, it seems like this is just dragging out longer than maybe many people thought it should, rather than us getting to maybe a conclusion or just getting the worst behind us and moving on. It just seems like we just can continue to drag on and drag on.
Ben, it's a really good point. And if you stop and think about it, so remember in March and April of 2020 when COVID first hit and they said, hey, we're going to do a 30-day lockdown essentially, right?
Mm-hmm. Right.
Well, when they said that, I think myself and a lot of other people were like, okay, in 30 days we'll be okay. And it obviously went on far longer than that.
Right.
So when you have a global pandemic that had the impact that COVID did on trade, supply, population, healthcare, and then you have governments around the world pumping, trillions and trillions of dollars into the system, that hangover does not go away overnight. From an economic standpoint, the global trade has changed forever. There's tons and tons of companies getting out of China in droves because I think they realize there are serious issues with putting all your eggs in one basket. So COVID changed a lot of things, and you said it perfectly. There's a haze that's still hanging over us. Some of it's never going to go away. We hope that the inflationary piece, which unfortunately affects all of us in a big way, right? You go to the grocery store, everything I buy, I'm just like, wow. Stuff's twice as expensive. And we hope that gets more in line, and it will. It is taking longer than we thought.
It is taking a while. I saw an interesting maybe tweet, I think it was, but just talking about kind of where mortgage rates are and the amount of home you get now and the interest you'll pay. But I saw that in 2021, a 30-year average fixed rate of just around 3%. A $400,000 mortgage would have cost you about a little over $600,000. At the current rates, or when rates were around 7.5, 7.6, it would cost you over $1 million. It's just a crazy situation we've been in, and probably one that you really haven't seen much. But it just got me thinking, like, what inventory was already kind of low, right? As it was, the demand's been pretty high. But what happens in this? Like, what gives first? Is it people that that are still willing to move and buy their home, or is more inventory come on the market? Like, what is kind of the tilting point here? As people say, oh, I've got a 3% mortgage, I don't know that I want to move necessarily, although we talk about reasons why you don't necessarily want that to kind of keep you in place.
It's a great question. And there's been a lot of studies done on this exact question. So what we're seeing right now is the people that are moving with the rates in the 7% range, they're the have to move people, not the I want an extra bedroom or we want a little more land, or because that want is not as great as, I've got to give up a 3% rate and change it into a 7% rate and pay that much more interest, like you just mentioned, right? So those people are staying put. The inflection point is 5.5%. is what most studies are saying. At 5.5%, a lot of families are going to decide that it's time to move again. And what we see right now is a lot of first-time home buyers, because the first-time home buyer, when you look at renting, even at these rates, it's still much more economically advantageous to buy versus rent. So those are like the people that almost have to, because renting is just so lopsided. And, as you've, I'm sure, heard from friends and family and people renting is just so expensive right now. You can certainly own a home with a payment based on a 7% rate at a much lower payment than you can pay for in rent in a comparable property.
Yeah, it's a crazy time right now, for sure. And it's not easy on a lot of people. And hopefully that you can get the help that you need to find that next mortgage that you're in. Bill, the one product I wish it existed is we could just transfer that mortgage I have right now at 3% or 3.5% to my new home. If we could just invent that product, we could just transfer that mortgage rate to our new home and our new purchase, it would just solve all the issues.
So there's something similar with an assumable mortgage, which FHA and VA have, which means that the mortgage that's 3% on 123 West Main Street can stay on that property. So that is something that is available with, a small percentage of the loans out there. There are problems with that acquisition of the loan. So we rarely see people do it.
Yeah.
So a portable mortgage, as you've mentioned, would be a very interesting concept.
It would be awesome. I mean, it would definitely incentivize a lot more people to be active and get out in the market. But anyway, I digress. We'll keep an eye on the market and inflation and the rates as we move forward. If that 5.5%, that's interesting. That's kind of the inflection point you've seen from studies. So something to keep an eye on, and we'll track while we're moving forward. But if you have questions for Bill, want to follow up with him, talk about mortgage opportunities, what options are out there potentially for you if you are in that, hey, I need to move kind of spot right now, and you're looking for a home and need somebody to work with, Cross Country Mortgage can definitely help you out and benefit you. You can get in touch with him in a couple different ways: over the phone at 484-352-4151 or online, smartmortgageshow.com. This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.